Okay, let's start. Good evening, guys, and welcome to this class this evening. This class happens to be like the first class we are doing as 1, 2, 3, 4 X. Normally, we have been having morning sessions, yeah, morning output sessions. But today, based on popular demand, we decided that we're going to have a class, and then the topic that was chosen, yeah, you guys said you wanted the topic from the advanced side. So I was actually thinking about the topic to talk about, and something just hit me that I should talk about the trading process. Now, it's not like it's something a topic. I just coined it out. Yeah, I just named something that I feel a lot of us go through. Yeah, as traders, and why I decided to talk about this stuff is based off of my experience, the experience I had last year when I knew I was not like a beginner. I knew I was not an intermediate person. I was like, I passed that whole mastery level, like I passed the mastery class, but then I still didn't have that system to make me money. Are you guys following? So it was like I had the tools, but then I couldn't make the finished product yet. So I was basically jumping from one strategy to another, jumping from one mentor to another, looking for like that whole perfect strategy, looking for that whole perfect strategy. You get? So that, and I think what made me even decide to like talk about it, what even reminded me about it, I think the other day, someone made mention that they're in that place where they still don't know what works. Like even after the whole lectures and all, they're still finding it hard knowing what works, like what exactly is working to actually put them to make them profitable. So I was like, okay, let me just talk about this experience and then how I feel we can actually overcome it. And then I was like, okay, I'll name it what the trading process. So it's not going to be speaker class where we go to the charts and do stuff. This is basically going to be more of like a theory, but I'll try my best to not make it boring. Yeah. So that's being said, let's get into the whole matter of today. Let me get this stuff. So the outline, yeah, we're going to be looking at what is trading fundamentally, yeah, and then what you need to know as a trader, and then the trading process, and then education. Like I always say, it's not about the name of the topic, but then the message. I would love you guys to digest the message all this thing has today. Wait, before we continue, is my audio clear? Can you guys hear me very well? Please, can someone indicate? Can you guys hear me clearly? Hello, are you guys with me? Okay, cool. Let's go ahead. So that being said, we'll be starting with what the first one, which is what is trading fundamentally. So now what this whole topic is about here is basically what we need to understand as traders. There are some basic things, there are some basic primitive things about trading, like to the like bottom that we need to understand about trading. Yeah. So now, if you happen to check up the definition of trading online there, you see a lot of different word definitions. But the one thing that would appear constantly in all definitions is what buying and selling. You always see what buying and selling or trading of currency pairs, yeah, against each other. But then the fundamental thing you always see is what buying, buying and selling. Now, yeah, fundamentally trading has to do with buying and selling. It doesn't matter whether it's currency pairs, commodities, crypto, and all. It's what buying and selling. Are you guys with me? So now, if you look at this from a probabilistic point of view or perspective, that's if you look at this, yeah, from probabilities, you see that what you understand that the chance for anyone That's what the chance for a buy or sell happening at any moment in the market is what 50-50, all things being equal. Now, what this means is that on a normal day, the chance for a buy happening and the chance for a sell happening is what 50-50. It's like the toss of a coin. If you throw a coin up, yeah, if you flip a coin, the chance of either head or tail happening is what 50-50. It's only two of them that can happen, and it's the same thing with the market. It's either what a buy or a sell that can happen at any moment in the market. Now, definitely, yeah, all things can never be what's equal in the market at any given moment. So yeah, there are times in the market when the chances of one thing happening instead of another one is high. Okay, so now there are chances that there are times that maybe the chance of a sell is higher than what the chance of a buy. And then the chance of what a buy is higher than a sell. There are always times like that. Now, our job as traders is identifying when this chance is when this whole chance, when like the chance of one thing happening is higher, and what's taking how like taking advantage of that stuff. Do you understand? So now the whole thing is 50-50. Get the chance of a buy or sell happening is 50-50, all things being equal. And all things cannot be equal. So now sometimes there will be times where the odds will favor what the buy. Let's say the buy will now be 8. There will be 80% chance of a buy happening than what a sell. And there will be times maybe the chance for a sell happening will be 90 than what the buy, which will be 10. Hope you guys understand this whole probabilistic point of view I'm talking about. Are you guys following me?
Yes.
So now, how do we know? Yeah, because now we've established that our job as traders is actually to find out when the chances of one is actually greater than another one. So now, how do we know when there's a high chance of one thing happening against another? That's where our strategy comes in. Those of you that are used to my sessions and classes, you know that I always talk about these things. Yeah, the strategy only indicates a high chance of one thing happening against another. There are only two things that can happen. Your strategy tells you that okay, now a buy, there's a high chance that a buy will happen more than sell. I guys, now it uses certain parameters to help you identify when the chance of something happening is high. Now these parameters are basically variables like your entry criteria, market structure. It uses these parameters. There are certain parameters that when they happen, there are certain variables when they happen, you know that okay, this is what is telling me that there's a high chance that the buy is going to happen. Do you guys understand? Now, our job as traders, like I said, is basically to interpret market information and to act on whatever is perceived. Yeah, that is take a trade or sit out. That's you acting on whatever you perceive. So now let's see, I see market information, I open my charts, and then whatever I interpret from the market will make me to react. It's either I sit out or I take the trade. Do you guys understand? So now identifying and interpreting what the market is doing currently and using it to forecast what the market will do next. That's basically what our job. Identifying and interpreting what the market is doing currently and using it to forecast what the market will do next. So now what we basically do is look for the parameters of our strategy. In its rawest form, that's basically what we do. Forget all the English. Yeah. What we basically do is look for the parameters of our strategy, look for the variables. And when we see these parameters and they indicate that a chance of either a buy or sell happening is high, we can act on them by taking the trade. But it doesn't just stop there. We also have to manage the trade and our accounts. That's basically trade management and risk management. Now, as we go further, we'll uncover all these things in details. Yeah. So now the next thing we'll talk about is what we need to know as traders. Yeah, this is like a redundancy. Yeah, but I just wanted to talk about these ones before we get in depth. Yeah. Now, I think as traders, there are certain things. As traders, I feel there are certain things we need to know. There are certain things we have to figure out. Yeah, it's going to take time, it's going to take a while, but as traders, yeah, we need to figure some of these things out, or we need to what? Yeah, basically, we need to figure them out, and that's the essence of what this lecture, to help you know how you're supposed to what, figure them out. Do you understand? So now, first, you need to know the type of trader you are, whether you're a swing trader, day trader, or a scalper. Next one is what? Market structure. Understand it. This is the bedrock of all strategies. Understand what's market structure. This helps you with what? Getting your buyers. This helps you know what kind of positions you're supposed to be looking for. Now, how to marry the different time frames. That's basically your top-down analysis. What time frames to use and the rules for what each time frame. Now, the another thing you need to what figure out is what your strategy. Most people, we need to figure this one out, but most people tend to what overemphasize this thing. Yeah, you need to what find that thing that will gives you an edge in the market, that thing that will put the odds in your favor, that thing that gives you that expo that okay, one thing is going to happen against the other one, and then another thing. One of the biggest ones is what risk management. No trader can be complete without risk management. Yeah. So now, as we go further, we'll look at all these things, if not more than all of them, in depth. Yeah, under the what topic of what the trading process. So now, in this section, yeah, I'll be attempting to break down what we as traders need to focus on and off the charts in our quest for what profitability. Basically, in this whole road of trading, yeah, there are certain things we need to figure out, and this lecture is going to help us break down what we need to figure out and how we need to figure them out. Basically, what we're supposed to be looking at, what we need to focus on and off the charts. Yeah, so now I'll be looking at them under what these headings was the time frames to use, market structure, risk management, strategy, trade management, and emotional intelligence. So now, why I'm starting out with, why I'm lining them out is like this here is basically how it's basically like a trading process. Now, if I open my charts to trade, first I'm gonna have to know the time frames I have to use, understand market structure to determine my bias. Then what risk management, I have to predefine my risk before taking the trade, know what I am willing to risk before taking the trade. Now, strategy. My strategy comes in to help me identify these trades or these setups. Then trade management. After I take the setup, what do I do? Manage the trade. And what emotional intelligence not on and off the charts, yes, and then what's in and what's out of the trade. That's why I lined them out like this, and we're going to be looking at them one by one. As traders, yeah, I feel these are the things. These are the things that would complete us. There are other things, yeah, there are other additional stuff, yeah, but I feel these are the main ones. Yeah, I think once you piece these ones together, you are like more than halfway towards profitability. So now, we'll be looking at them. The first one is what time frames to use. Now, one of the important things we as traders need to figure out is what time frames to use and what rules to assign to each time frame. As traders, yeah, those of you that attended my top-down analysis class, yeah, those of you that have been in my top-down analysis class know that as traders, we need to have our directional mid and key time frames. Do you get? Now, this actually stems out from the kind of trader we are. Do you get? That's why I said you need to determine the kind of trader you are. Yeah. Once you determine the kind of trader you are, then you know what time frames you're supposed to be using. Now, this can be figured out by looking at our lifestyle, risk appetite, and what the time we spend on our charts. So now, our lifestyle, basically, there are some people that can wait for long for something to develop, for something to actually come out, for something to actually, how will I put it now? There's this word I'm looking for. Something to manifest. Yeah. Some of us can wait 2-3 days, hold the trade 2-3 days to hit our profits. Some can't. Some can't even wait for an hour. Do you understand? Now, another one is risk appetite. Some people are willing to risk half of their account per trade. Some people cannot even risk 1% per trade. Then time we spend on our charts. Yeah. Some people actually spend a lot of time on the charts, and then some barely have time, especially those that are working. Yeah, so now it's for me, these three things that will determine the kind of trader you are. Now, for lifestyle, if you're someone that cannot hold trades for long. Trade the lower time frames. Yeah, where in less than 15 minutes you hit your ROTC. Yeah, then risk appetite. Yeah, if you're risking high, you're not supposed to be trading the lower time frames because there are a lot of what setups that happen on the lower time frame, but then it's not all of them would actualize. Yeah, your risk to your exposure to risk on the lower time frames are what's always higher than what your exposure on the higher time frames. Yeah. So now, time we spend on charts. If you spend less times on charts, trade higher time frames. You can't be spending less time on charts, why? And trading lower time frames. Trade higher time frames instead of trade lower time frames. Trade lower time frames, then you are basically going to be sending yourself to an early grade. Now, it's really important to figure this out because it helps us figure out, filter out the noise of other time frames. Now, once you figure this out here, you know what you're supposed to be looking at for. Now, once you come to the charts, you know what you are like laser focused. You know what you're supposed to be looking out for. I'm like, okay, once I get to the charts, as a day trader, I know that the first thing I'm supposed to look at is the 4 hour. Yeah. Now, apart from the 4 hour, what am I supposed to be looking at for? My mid time frame is the 1 hour. That's where I highlight areas and points of interest. Sorry guys, I had a problem I had to take care of. So as I was saying, yeah, it's really important that we figure this out because it helps us filter out the noise on the other time frames. I know how it's always very confusing looking at all time frames and then you really don't know what you're supposed to be looking at. In short, you don't even know which time frame you're supposed to be looking for. And at the same time, you don't even know what you're supposed to be looking at for on a time frame. But what this helps you with, this helps you with is what? First, it's not just the time frames you get to use. You actually know also those time frames. So that's basically why this whole time frame series is very important. Now it's also what helps us know what exactly time frames to look out for, like I said, and also what exactly to look out for on those time frames. Now, as traders here, we need to have our first directional time frame. Like I said, this is basically usually a higher time frame. Yeah, as we all know, I'm just repeating this for those that are not up to the mastery level because I'm guessing those in the mastery level actually know this. Yeah, the directional time frame is usually a higher time frame. This is basically used to know the main direction or the trend of the market. This is basically used to generate your bias based off of what this main time frame does. You know what kind of trades you're supposed to be looking at for. Because most times the higher time frames always prevail. Now, your mid time frame, this is basically used to highlight our points or areas of interest. These are basically the areas where you feel, it's not basically you feel, these are areas where price has a high probability of reacting from. Because basically that's what our job as traders is, getting to find out those areas and then making ourselves ready to actually capitalize on them anytime they happen. Now, the next one we need to figure out is our entry time frame. The next one we need to not figure out is our entry time frame. This is basically what you use to look for our entry criteria and to take the trade. It's usually the lowest time frame. Because here you get to have smaller stops and then you get to see things before they actually show on the bigger time frames. Yeah. Hope you guys are following me. Hope you guys understand.
Yes.
So far, it has not been boring. Okay, so now let's go to the next one. market structure. Another thing we as traders need to what understand or know here is what market structure. Now, by definition, what market structure is what the behavior, condition, and current flow of the market. You guys understand the behavior, condition, and what current flow of the market. Market structure is basically what the breathing pattern of the market. It's like I said before we started. As I was saying, yeah, it's basically what the bedrock of all what strategies is. How the market moves. The market doesn't what just move in what straight lines, but what it moves in series of what impulsive, what corrective moves. Basically, what retracements. Do you guys understand? So now, understanding this what aids us to forecast where the market is headed to, from just what looking at the previous moves and what it what does in the moment. So now let me explain this. Yeah, let me get pen instead of pen. Good. So now, yeah, the market doesn't just move in straight lines like this. Yeah, the market moves in what if it's an uptrend moves in what series of what impulsive moves and then what corrective moves, which are what retracement. Corrective moves. Yeah. So now, understanding this whole thing, yeah, if it's in a downtrend, yeah, the impulsive move is going to be down, corrective is going to be up, impulsive down, and then corrective what's up. So now, understanding this, yeah, anytime you see the market in an uptrend, yeah, you know that okay, if what I'm supposed to be looking out for is what to be able to what catch the next what impulsive move. Now, once you catch that impulsive move, you are assured that what it's going to ride up onto what this level. You understand? Break past that level to create what another high. So you understand that it moves in what's higher highs and what's higher lows. Now you buy from the higher low and what exit at what the higher high. That's basically so now it's this whole automatic confirmation, yeah, that okay, once the market is an uptrend, if I take a buy from a higher low, it's expected that a higher high will form, so I can ride it to the upside. Market structure is very important to get. That's why it's very important in helping us forecast where the market is was headed to. Now, at any moment, if I see what, let's say it's in a downtrend, and I see what structure is being broken, I know that okay, this is no more it's no more a downtrend, so I'm uptrend now. That's how it helps you with what the bias. I get to know that at this moment now, from this moment, it's only what buys I'm supposed to be taking, not what sells. There's there's a high probability of what buys happening now with sells in this case. Hope you guys are following. Hope you guys are with me. Okay, cool. So now let's continue. Like I said, yeah, understanding this helps us forecast where the market is headed just from what looking at its previous moves and what it does at the moment. Now, as traders here, we need to understand what up and down trends look like first and what ranging market conditions are and look like. Do you guys understand? Those are basically the three words market structure formations. Downtrends, uptrends, and what ranging market conditions. Now, we need to also know what invalidates the trend. What are what reversal signals? What reversal signals? You get okay, if there's an uptrend, at what point do I what conclude that this is no more an uptrend and this is a downtrend? You need to what understand that. We need to what know what these things look like. We also need to what understand what characterizes what clear breaks of structure. Because the market is never going to form but perfect. There are sometimes where there are things that you need very strict rules and parameters to what determine them for you. For me, a clear break of structure is anytime I see what a full body closure above or below a level. That's a clear break of structure for me. If I see only a week, it's not a clear break of structure. Now you need this kind of rules For other people, it might be different. Do you understand? But you need this kind of rules to determine all these things for you. As traders, it's what understand this. This is like the bedrock of everything. It's what forms your bias. Hope you guys are with me. So the next thing we look at is what risk management. Now, before every trade, yeah, we need to what predefine our risk, define it, because this is basically what helps us manage our capital. Yeah. So now risk management by definition refers to what the processes that are put into place when trading to help keep losses under control or risk to reward ratio. Yeah. So now those of you that are not familiar with what a risk to reward is, yeah, risk to reward is basically the the ratio of what you are risking compared to what you are getting. Do you guys understand? It's basically, let's say, if I have a 1 to 2 risk to reward ratio, it means I'm risking one to what get two. Let's say I'm risking $100 to get what $200 for that trade. To get risk management helps us what keep all these things under control. Now, risk management is really important because it rations money per trader and allows room for what your strategy to work. Do you get? So now, what risk management does here is that what it helps you in those times where you have what losing streaks. Yeah. Now, even the best strategies will have what losing streaks, and as traders, we need to what. Sorry, as traders, we never know when this is going to come. Because, like I used to tell you guys, there's a random distribution between wins and losses for any strategy. What this thing means here, first, we know that even if it's a 90% win rate, yeah, there will be a time where you have that 1% what? That 1% loss. So let's say out of 10 trades, yeah, you have that. You have what? One loss. Yeah, out of what 10 trades. Now we don't know where that one loss is going to come. We don't know whether it's going to be after 5 trades, whether it's going to be the first trade, whether it's going to be the ninth trade, or whether it's going to be the 10th trade. That's what this whole thing means. That's what a random distribution between wins and losses means for any strategy. So now risk management helps us what manage our capital so that when we have what's losing trades, we end up what's being profitable after what's a series of trades. Now, we can figure this out for ourselves in what 2 ways. Yeah. First, the first way is the first way to what figure this out is what anytime you risk a certain percentage of your account and you feel anxiety about losing the money, then you are not willing to what, risk that percentage per trade, but reduce it. So let's say I risk $200 or I risk 2% of my accounts per trade. Yeah, for a trade. And then throughout that trade, I'm feeling all this whole anxiety. I'm like scared. I don't want to lose this money. Then I'm not willing to risk it. Do you guys understand? Now the second way you can do this is what? How many trades you take a day. So now let's say you take more trades a day or trade on the lower time frame. Now another way you can look at this is what how many trades you take. Sorry, my system is giving me issues. It's lagging. Hopefully it won't happen again. So now the second way you can look at this, yeah, it's like how many trades you take a day. When you take more trades in a day, yeah, or you trade on the lower time frame, there are lots of your setups. Your exposure to risk is always high. So what's always slow. Now I'm going to explain this here, how it works in percentages here. Let's say you have a 70% ratio, yeah, and you're taking, and let's say you're trading on the lower time frame, and then you're taking 10 trades a day. Okay. I'll answer your question in a minute. So let's say you have a 100%, sorry, not 100%, 70% was with strategy, and then you are taking 10 trades per day on the lower time frame. You are trading on the lower time frame where you are seeing more than 10 setups. Yeah. Let's say you're taking 10 setups now. Let's say you have 10 setups and then you take all of them. Yeah. What this means is that your strategy is what? 70%. You're going to have what? Seven wins and what? 3 losses. Do you get? Now, the more trades you take, let's say you're taking 20 trades on that lower time frame, you are going to have what? You are going to have 14 wins and what? 6 losses. Do you guys understand? So now the more trades you take, the more exposure to risk you have. So what? To reduce the amount you risk. You don't expect me to be taking 20 trades per day with the expectation of losing 6, and they expect me to be risking maybe 5% of my account. Do you understand? What if I have all those 6 losses in a row? 5% of my account times 6. That's how much. That's like 30. Yeah, 30% of accounts gone in the day. You'll be demoralized. Do you understand? You'll not be able to even take the next trade. Even the next day, you won't be able to take it. So now, this is what the second way you can look at it. The second way you can determine it. If you take more trades in a day, reduce the amount you risk per trade. And the first one is what? Anytime you risk a certain percentage of your account and feel that whole anxiety on ease, reduce the amount. So now, Royal Tech asked the question that's $200 and you want to risk 2% per trade. Mean like willing to lose only 4% in that trade? Yes. So now, yeah, it's not just if you want to risk 2%, you're willing to lose that $4 for that trade. If $4 go now and you're crying, then it means you are not willing to lose that $4 per trade. Do you understand? You can be willing to lose it in a day, but maybe not per trade. Do you get? So now, it's important to say, yeah, this will still answer your question. It's important to say that what as risk takers, our job just stop at what risking money. We also need to what accept risk. Yeah, that's what accepting the possibility that there's a chance of losing the money. So now, before every trade, you need to accept that okay, there's a possibility. Yeah, it can happen. Do you get? Your strategy is 70%. So now, what this means is that the 70% chance that this thing is going to happen, there's still that 30% possibility that it might not happen. So you can lose that money. That chance is there that you can lose that money. So accept it before the trade, so that when it happens, you don't dwell too much on it. Basically, what you do is like place yourself in that avenue where you can learn from it. You guys are following. I hope you're following. Hope you understand. Cool. So now what's another thing we need to do is what we also need to predefine our risk amount and percentage before any trade. You need to, like I said before, you need to know this one before you take any trade. It's not when you have a set of unfinished that you start thinking about what am I supposed to risk for this setup. Now, before we go into the next part, yeah, need to rejoin here. This mission is remaining just 2 minutes to end. So I'm going to close it. I'm going to end it manually from here. So you guys, what I need you guys to do for me is what you join with the same link. The same link I sent to my group chat. Join with the same link. Yeah. Hope that's clear. Hope that's clear, guys. Bye, guys, with me at all.